My name is Olu Oyinsan, and I manage an early stage fund called Oui Capital. We invest primarily in pre-seed and seed stage companies across the African continent. Today we have a portfolio of about 25 companies from across 8 or 9 African countries, East, West, and Southern Africa. Muktar, I like to use it as a firm thing, not because truthfully, a lot of people think it's investors' money. It's not our money. We're rich, poor people, right? We're poor people who control a lot of money, and so just saying it, putting it out there. So I think it will be great to understand how many people in the house are founders. If you're a founder, let me see your hand. Okay, interesting. So the driver of returns is value. Let's start from there, right? If there's no value in something, you can't return. So return is when you convert value to cash, basically, right? If there's no value, there's nothing to convert to cash. So some people might not know the monies that investors, VCs, PE funds invest in startups is taken from other people called LPs. So we have investors too. So when you think a VC is showing you shege, they've seen times 10 of that, right? I keep telling the story of how I went from Lagos to Hong Kong for $100,000 check for the first fund. And I came back from Hong Kong and I still didn't get that money. Yeah? I found the cheapest flights. This was probably 8 years ago, maybe $1,000, $1,200. And I still didn't get that money. So if you've gone from here to Hong Kong for an investor and you didn't get the money, then you can start talking about your difficulty with VCs. But first, you have to invest in something that has value before you start talking about converting that value to money. And that's where returns actually comes from. So the biggest driver of returns is creating value. And for us, is investing in a company that can create value. And what is value on the company level, right? Value on the company level is revenue, is cash flow, is profit. If you're not creating any of these things, it's hard to say you're creating value, except you're doing like an NGO, pseudo-philanthropy. So I think the major thing to focus on is what we call unit economics. That is, for every new client you service, is that person or is that firm or is that customer adding to the profitability profile of your company? This is the major thing, right? And the question is, even if you're making a loss, for example, on the whole company, but every time you service a new customer or a new client, are you getting closer to profitability? AKA, if you spend 50 naira serving this customer, are you getting 55? Are you getting 70? And is it contributing to what we call fixed cost recovery? Basically, is it moving the company's profitability profile forward? If it's not, chances are that long term, you're still not going to create value. If I buy this bottle of water every time for 50 naira and I sell it for 55 naira, even if my rent is 5 million naira, there is a number of bottles of water that I will sell that will eventually cover my rent because I'm going to make 5 naira from each, right? One day I'm going to sell so many bottles of water that it's going to become profitable as a company. So moving you towards there, if you're buying it for 50 naira and you're selling it for 50 naira or less than that, then you're not going to create value in the long run. The reason why you've started the business is to create value, right? You don't have to get money first, but your unit level economics, even if you're making a loss, you have to be able to say, by the time I sell so many units of this, or by the time I serve so many units of these customers, or by the time I get so many users, I will become profitable. So you know you're trending towards a positive unit economics. I would consider a fund like a house with many pillars, right? And maybe it takes about 4 or 5 pillars to make that house stand. So even if you have about 20 or 40 pillars, if most of them break, which is like startups, the house is not going to fall. But there's a number that when it falls, the house is going to fall, and that's your fund. So you can have successful investments, but not a successful fund. And you can have many just mildly successful investments and a very successful fund. And that's why you create what we call a portfolio. What you need to do invariably is make sure that in all the investments you've made, at least a few can make you back all the money you've invested in all the companies. And this is why sometimes when you go to a VC with an idea or a business that is going to make them substantial amount of money, maybe 2 times their money, 3 times their money, 4 times their money, they still turn it down. The problem is they're looking for deals that on their own stand the chance to return all the money they've put in all these companies, because the truth is about 80% of all investments that venture capitalists make fail. And so you have to construct your portfolio in a way where if some pillars fall, the whole house is not going to fall. That means you need to diversify sometimes across sectors, sometimes across currencies, sometimes across stages, and just sometimes across the number of companies in your portfolio. So remember, these things are the North Star, right? And we're not talking impact or pseudo philanthropy here. We're talking about business. The revenue and the profitability. These are the 2 biggest drivers of people going into business. Every other thing has to align to get you those things. And that's why we check the product, because if the product is not good, even if you're selling today, you're not going to sell for a long time. You know, people who put WhatsApp status, or if your friends don't support your business, block them. Or strangers that are going to support your business more than your friends. The reason why you need your friends to buy from you is because your product is not good, right? If your product is good and it solves a need for people and you put it in their faces, you will not need your friends to buy. If they buy, it's not going to be substantial anyways. How many can they really buy, right? So the reason why we check if the product is good is because we need to know if you can sell to people that are not your friends. And those are the people that are going to drive long-term revenue for you. And if your costs on a unit level economics basis is lower than your revenue, you will eventually get to profitability. And that's why the product is important. Outside that, as they always say, you're looking at the founder. I actually look at the product and the problem you're going to solve more than the founder, right? It's very cliche to say, oh, it's the founder. Sometimes brilliant people put themselves against problems that are insurmountable, and it becomes a problem, right? But you need to really figure out the team that's behind it. First of all, are they going to stay together? Do they have a strong why? And the reason why you're checking for their why is because your why is going to determine what's going to happen when going gets tough. For example, people have tried to build cancer cures because they lost maybe a close one or a relative to cancer. When it gets tough, right, the memory of that person keeps them going, rather than someone who saw a YouTube video and just said, oh, I think I should try to build a cure to cancer. And that's why your why is very important. So you want to really figure out the founder's why or the team's why, their capability. Do they have experience in those industries? Do they have networks in those industries? And then you look at the product and then the market they're trying to serve. Okay, so first of all, you don't invest in any company that you don't think can return your whole fund. This is usually the problem, right? You have to have that kind of conviction. And if you don't have that conviction, you have to walk away. And this is for venture capital, not like debt or private equity. Those things are different. And that's why sometimes you have to invest like a madman. Imagine someone who was investing in Airbnb initially. You're telling someone, oh, I'm going to build an app, and then a stranger is going to come to my house and sleep in the other room, and they will not strangle me at night. Me too, I'll now go and sleep and close my 2 eyes. In the morning, they'll pay me and they'll go. You have to be insane, right? But people do it now. And so when you are investing, you have to, as a good VC, some nuts and bolts have to be loose in your head too. Because when you believe that kind of thing, or you believe that, oh, there are taxis everywhere, I'm going to create an app, the taxi that doesn't know where I am is going to find me, come pick me up, take me to where I'm going. I don't have to talk to the driver, he'll drop me off and they'll get paid on the app. If you're a millennial like me who's close to 40, you will know that at some point it was madness, because you have to walk down your street and find those babas in yellow cabs. But now it's an everyday thing. And so you have to go for the long shots, things that you feel, if this goes well, it's going to go very, very well. And when you do that, you have to invest in a lot of them. I'm going to give you an example. There was a company built by three gentlemen, probably average age 22, in Lagos about 4 years ago. I won't mention the name. Smart guys, they were building a no-code platform, right? So what you call no-code plus agentic AI today, 4 years ago, out of Lagos. And they were raising, I think, maybe 100,000 US dollars. I did have a small fund at the time, but we knew if this goes well, it's going to go very, very well. The market in Nigeria is big, but the market outside Nigeria is even bigger. And I picked up the phone and called a co-investor out of Silicon Valley. He's an early investor in SpaceX, in Snapchat, in DoorDash. And I called him and I said, Justin, these guys out of Nigeria are building something incredible. He said, let me talk to them. And when he came out of that meeting, he said, I've never felt more excited about a team building something, except when I spoke to the guys that started Snapchat. These guys are in Lagos, three 22-year-old boys. That company is no longer around. It died after like 2 years. But the reason why they're no longer around is because they were very smart, great guys at building product, but they couldn't really sell. And when you can't really sell, it means your product might not go very far. And also, you might not be able to sell that company to other investors to invest in, right? And so a lot of things kill companies except product. But I would say that was probably the most interesting investment that I had high hopes for that didn't pan out. I think they needed to be stronger in their ability to sell. You know, sometimes you get too smart that you forget to go out and touch grass and talk to people and sell your product to either customers or to investors. And you know, a lot of people feel they're not smart, but they're out there talking to everybody and they make progress. So you need a combination of both. I think they were just a little too technical and they couldn't sell the product.